And we will bring out our first panel that's going to be moderated by Tim Massad. Tim is on the board of the Psaros Center, former chair of the CFTC. And then we have Nandini Sukumar. Nandini is the CEO of the World Federation of Exchanges. Sapna Patel, a real expert on market structure from Morgan Stanley. We have Chuck Mack from Nasdaq, and Kathy Clay from Cboe, touching on the derivatives markets, and our very own Jim Angel, Professor Angel. Yeah. Take it away, Tim.
Okay. Thank you, Rena, and thank you, Mike, and thanks to all the staff and student volunteers who've made this excellent conference possible, and it's just great to see such a great crowd and lots of students here. We're here to talk about market structure. We don't have much time, so we're going to jump right into it. The U.S. capital markets are the strongest, deepest, most efficient in the world. They are also very complicated, and the structure has evolved in part in response to rules, regulations from the SEC and the CFTC, but sometimes in ways that the regulators didn't necessarily intend. Today, the SEC has 4 proposals that it put out about 2 years ago that are referred to as the market structure proposals. And we're going to start with those. There was a proposal on requiring a new best execution obligation for brokers, which would be an SEC-mandated best execution. We already have best execution obligations from FINRA and from municipal securities. There was an order competition proposal, which would mandate segmented auctions for retail trades. There was a proposal to change minimum tick sizes and limit the fees that exchanges can charge to access their liquidity, and a proposal on disclosure of order execution information. Now, the SEC acted on that last one earlier this year with changes to what's called Rule 605. They have a meeting on Wednesday, tomorrow, where they are scheduled to act on the minimum tick sizes. But let's face it, we have an election in 2 months. There's going to be a new president in 4 months. So the question is, what happens with the other proposals? And of course, the SEC has issued some additional proposals that affect market structure. I'm only highlighting the 4, but there was one in particular to outlaw volume-based pricing incentives offered by exchanges. I know Chuck may have some thoughts on that one. So these proposals have sparked a lot of debate. There are those who say they're trying to fix what isn't broken. There are those who would say, well, maybe some of these changes are needed, but let's take it a lot more slowly, and lots of other views. So I want to turn to our panel and get your thoughts. And I'm going to start with Sapna because her title is Head of America's Market Structure. So I think it's appropriate to give her the first word.
Thanks, Tim. I wanted to just start by thanking Professor Agrawal and Georgetown for hosting this conference, and it's an honor to be up here with my fellow panelist and moderator. So thank you. Where to begin with the equity proposals? We can spend an entire day talking about them, and I've been told we have.
What do you think is going to happen? What would you like to see happen?
So we got the meeting tomorrow. Second of the 4 equity market structure proposals. We're hearing that best execution's teed up after that, possibly saying the order competition one after that. I think you kind of teed this up very carefully with the elections. How much can the SEC can get done in the next several months by the end of the year if there is a change in the White House, or even if there's a new president coming in? So they have to really pick the proposals that are out there, and there are a lot of them, that are the most important to them. The equity market structure proposals combined are the biggest change to our equities markets proposed since 2005 when Reg NMS was adopted. And I was at the SEC, I got to work on that proposal back in the day. The question that we've all been asking ourselves for the last 2.5 years, regardless of the hat that we wear and the seat that we're in, is what are we trying to solve for in the equities markets? I think the biggest test of the infrastructure that we have in the equities markets was the early ons of the pandemic. And retail and institutional investors could continue trading during that time because of the market structure that we put in place. So it works well. I don't think any of us up here will say we don't need changes. We don't need to adapt to kind of changes in technology, trading behaviors. We're not saying don't touch the market structure, but I don't think we need to fundamentally kind of throw it out and start from scratch at this point.
A lot of these proposals are meant to make sure the markets are fair to retail investors. And of course, we have, the quick way to describe market structure is we've got, 16 equity exchanges and 30-some ATSs on top of that. Chuck, from your standpoint, being with Nasdaq, how do you think about these proposals? And in particular, what do we need to do to make sure the markets are fair to retail investors?
Yeah, a couple of thoughts on that. First, I want to echo Sapna's thanks. Very honored to be here. Thank you to Georgetown, and it's great to be here with my fellow panelists. I think from the other thing I'd note is the proposals that you mentioned, about 1,600 pages of rule writing. So some riveting reading that happened across the industry when those came out.
Trying to forget about that.
Yeah, it might give you a headache just to think about that. So I think you kind of nailed it, Tim, when you talked about the markets being the deepest, most liquid, working really well, but they're complicated, which is, I think, a fair point. And technology is what enabled the market's ability to deal with the complexity. It has really enabled it to work together and be stitched together, even though it's a little bit fragmented in many ways. I think, like Sapna said, there's probably almost nobody who would say, hey, we don't want any change. I think people recognize that there's always ways to make things better. You do want to be cautious. We've now said maybe 3 or 4 times how it works really well. So what we had said when these proposals came out was just how complex the proposals are themselves, especially when you put them together on top of an already well-working but complex system. And we had a concern that you wouldn't really be able to understand what was working and what was breaking as these things were rolled out. And so we thought that was really a major problem with the proposals. There are things we'd love to see change. We are proponents of tick size change. We do think there's inefficiencies tied to the tick size. When things went from fractions, yes, we used to trade in fractions, to pennies, efficiency just exploded. There are other factors at play, of course, like technology. But there's room for incremental change. And that by itself, in our view, would be a significant step forward that would allow us to kind of observe the impact, which we think would be positive. Just the tick size by itself. So, you've got, I don't know the count, but probably 30, 40 other little things piled on top of that. Right. And obviously,
and this, just if I may interrupt you, just so everybody understands, the tick size proposal that it sounds like they're going to act on is actually what they call the alternative proposal, which is a lot simpler than the original proposal, because that was going to create 4 different tick sizes and lots of complexity, and now they're just talking about a much simpler change. But anyway,
yeah, very complex.
What you're really pointing out is how these different things interact, and can you even predict those interactions?
Yeah, I think that's right, especially when you put them all together.
Right.
And then when it's actually out there, can you understand what's causing what if there's all these different variables moving at the same time? If you do a science experiment, you don't put 50 new variables in place. You change one variable so you can understand the impact of that variable before you move on to the next.
But if you're chairman and you know you have a limited term, sometimes you want to push a lot of things all at once. Catherine, I want to turn to you because these proposals are focused on the equity markets. The derivatives markets, though, have seen, and they're focused on retail investors. But the derivative markets have seen an increase in retail investor participation. How do you think about at least the principles that the SEC is focused on and the fairness of the options markets to retail investors?
Well, first, I would say that for all the proposals in front of us, we would advocate much more for a scalpel rather than a hammer, getting us to the precision of the changes that make sense versus whole-scale, perhaps doing harm proposals. And when you think about what happens in the equity market and how oftentimes what gets contemplated and passed in the equities markets finds its way over to the derivatives market. And I would say that is my gravest concern, is that for those that don't deeply understand the very liquid markets we have in derivatives in the US, to believe that you could actually just copy and paste equity market structure proposals into the derivatives markets could have really poor outcomes for us. And when you think about the retail trader, think about their experience in the derivatives market today. Costs have never been cheaper. Access has never been greater. Risk transfer mechanisms in the derivatives markets are important for our capital markets here in the US. And it's no surprise that across the world, the demand for that risk transfer mechanism, access to the capital markets in the US, is great. And so I do have concerns when we think about equity proposals finding its way to derivatives. And I'll just give you one example of a huge difference between the equity markets and the options markets. And that is the equity markets are order-driven. Take Amazon, for example, as an underlying stock. You have 3 data points with Amazon. You basically have a bid, ask, and a last that are really relevant to understand the dynamics of what's happening in that market. In the options world, there are almost 2,000 strikes on Amazon. So the amount of data, the amount of liquidity that we need to curate in active derivatives markets is just vastly different than the equities market. And so in the options market, we have a quote-driven market. We rely on market makers, liquidity providers to stand up quotes in Amazon in 2,000 strikes, day in and day out, irrespective of whether they trade or not. And so when you think about things like access fee caps and tick size proposals, they could be very dangerous if ported over without a lot of diligence into the equities market. And so my message here today is really one of caution, of not just porting over equity market structure without a lot of thinking into the derivatives markets.
Great. Jim, you're looking at all this from the perspective of an academic. You're not, you don't have an agenda of a particular firm. What do you think? Do we need these proposals? Are we fixing something that's not broken?
Well, first I'd like to echo what everyone else has already said. There's a lot of wisdom there. And I'd like to put this into perspective. Our Congress has endowed us with a fragmented and dysfunctional structure of hundreds of different regulatory agencies that can't figure out who regulates what and how. So it's not surprising that this dysfunctional system has given us these proposals that, shall we say, are not completely baked. And indeed, we see this misallocation of regulatory resources on areas which are actually functioning pretty well. As a retail investor myself, with a lot of gray hair, I remember what it was like trading back in the 1980s, when the minimum commission at a place like Schwab was nearly $50 for a single share. And I've seen commissions disappear. I've seen the bid-ask spread on stocks like Microsoft go from 25 cents to a penny. So as a retail investor, this is the best of all possible worlds, better than we've ever seen before. And to really gauge the impact of these proposals, you really will need a very high-powered academic microscope to see whether they do any good or not. And there are so many other areas where we should be putting our regulatory resources, whether it's figuring out a sane way to regulate crypto, whether it's dealing with better financial literacy, that we could go on and on of better uses of our regulatory resources. But it's really up to the Congress to have that conversation to figure out how to fix the mess they have endowed us with, because it's not going away. And I could go on and on.
I know all of you could. I know all of you have more to say, and we'll try to get into that. But I want to turn to Nandini, because you bring the global perspective to all this. We've kind of focused on the US, but you're looking at what's going on in the markets from a global perspective. What are your thoughts when you look at what the US is thinking about and doing, and how does that compare to what you're seeing abroad?
I think that, and I would like to start by congratulating Rena and David as well. When you look at US markets, I want to start always, whenever I'm in DC, I'm always struck by one thing, and that is how US markets are really, for the rest of the world, they are the envy of the rest of the world. They are the deepest, most liquid, most sophisticated, most successful markets in the world. And what the common thread that I have heard, and everyone really agrees on, is that we need to identify a problem before we solve it. If it isn't broken, don't fix it. And I think of markets, quite big markets, big developed markets that are still grappling with some of the issues that we've talked about. How do you attract the retail investor into the market? And I'm thinking specifically of a large first world country in Europe where they are still struggling, big exchange, but they're struggling with how do you get retail investors into the market and to understand the value of public markets. So if it isn't broken, don't fix it. But also, I think increasingly there is an understanding, a realization that you need an ecosystem approach. It can't be just one part of the market that is the solution. So it can't be, the exchange alone. If there's a problem, it isn't the exchange alone, and they aren't the only solution. So I do think all of us need to look at kind of the ecosystem. You need to look at the checks and balances, where the stresses are, and then you need to think, about how together people can solve a problem.
Okay, but recognizing that all of you have sort of said, let's do things incrementally, don't be rash, take it more slowly, be data-driven. I'm also hearing that. Let's talk about the two proposals where it's not clear what's going to happen: order competition and best execution. So on order competition, the idea is that retail investors today maybe aren't getting the best deal they could because of the way the system works. And the way the system works is there's what's called payment for order flow, where there are big wholesalers who essentially buy those orders and fill them. The SEC is saying, no, we think auctions would be better, arguably might benefit the exchanges, maybe. And then with best efforts, best execution, while we do have a mandate that brokers have to do that by FINRA, the SEC is saying, yeah, but there should really be an SEC mandate. Why aren't those principles at least good ones? Let me start with Sapna.
I think wanting to see competition in this space when it comes to execution of retail flow principally sounds like it should be an SEC kind of mandate, just overall, making sure that investors get the best possible execution. I think a lot of us would look at the structure today and say retail investors are. When they see a price on the screen, they get a better price than what they see. And that's partly the infrastructure that we have in place, where our marketable retail flow gets executed by the wholesalers who are involved with the payment of order flow that you talked about. But as a retail investor, you're getting prices better than others do in the marketplace, including institutional customers. When you look at introducing retail auctions into the marketplace, I think the difficulty with what the regulator wants the outcome to be and what's going to happen are two different things. And those of us actually involved in trading can see that. So we have a Reg NMS market structure where there's continuous trading during the day. The way that these auctions would work is that order flow is sent to them and held up for a certain amount of time, 100 to 300 milliseconds.
Sure. That sounds
some amount of time, and they're mandatory according to the proposal. So retail order flow is held up for that amount of time while continuous trading happens around it. Anyone who wants to interact with that retail flow basically gets held up for the same amount of time. It's a long enough period of time that people can game continuous trading. They can move their quotes away. You end up with possibly not getting an execution or getting a worse execution. So in practice, it's hard to have mandatory auctions in a continuous trading environment.
I mean, this is another topic where we could probably spend the whole day. I'll try not to do that. I think a couple points Sapna made I wanted to add to. One was about 300 milliseconds, which sounds like a very, very short period of time. But in our continuous market, it's actually a very long time where everything is automated. There's trades occurring every microsecond. I mean, it's very, very quick trading. So to Sapna's point, there are those concerns. I think the other thing, too, is when you try and solve least common denominator, it's very challenging. So would that concern apply in Microsoft that's super liquid and trades really well? Maybe not, but in something that's less liquid, which, by the way, if you look at do-it-yourself retail investors, they're often in less sort of well-known names. They're in the well-known names as well, but there's a lot of activity in these names that we maybe haven't heard of. And so you'd want to be, are we solving a problem there? Second, just looking at it slightly differently, I think of the whole ecosystem, we're a tremendously fragmented and segmented market. As Jim said, he gets a really good experience as a retail investor, and I don't think anyone who is sane would disagree with that. But at the same time, the retail activity that occurs there's not access to that from a broad perspective. Institutional portfolio managers don't have access to that retail liquidity, for example. So is there a way to kind of bring it more together? And the answer is maybe. And probably the question at hand here is the auction the way to do that? And from our perspective, the answer is no, for a couple reasons. One, there's the challenges that Sapna brought up. Two, it adds a ton of complexity. Three, as an exchange, while it might on the face of it look like, oh great, exchanges are going to get all this activity, we weren't convinced that would actually be the case, and it would actually be beneficial to exchanges because it was so prescriptive.
Mm-hmm. All right. I want to jump to another issue because you've both mentioned time. There's a more fundamental change going on in terms of timing, which is settlement, right? We've gone to what we call T+1, trade plus 1 day, meaning you make the trade and then the settlement, the movement of securities and cash, happens 1 day later. Now, decades ago, I think maybe even when I started my career, we were at like T+5, and then it was T+3, and now it's just recently T+1. I'm going to start with Nandini to give us the global perspective on T+1, but also maybe, if you want, touch on the other change that people at least are now talking about, which is, should our markets be operating on a 24/7 basis?
I think it's a huge moment when the U.S. market moved to T+1, because it's the world's largest equity market, and that you all have gone to T+1. In the WFE, at the WFE, we have probably about 300 exchanges and CCPs, so depending on how you count it. And I would say that every single exchange we know is in a non-US jurisdiction is evaluating T+1 to see if it will work for their market and if there are benefits that it will unlock for their market. It's very interesting. If you look around the world, just a quick snapshot, right now, Canada, right across the borders, obviously moved to T+1. We have India, which has gone with an interesting hybrid approach. It's kind of optional. You can do T+1 or you don't have to do T+1. And then you have Mexico, which has also gone to T+1. So you have all kinds of other markets that there are still markets in the WFE membership that are operating on T+5. And there are some markets where you are on T+0, and the T+0 markets tend to be frontier markets, and they're T+0 because they're pre-funded markets. So it's a huge topic right now. And I think what people are beginning to realize is that it may not work for every single market. Mm-hmm. And if you look, for example, at Europe, there's a great, interesting debate on whether Europe will ever be able to move to T+1 or not. And a lot of that, when you look beneath the surface, if you think about it, superficially, it's reasonably straightforward. You have a common regulator, you have different national competent authorities, jurisdictions, and very different economies within that. But will Europe ever be able to go to T+1 is an open debate now, and partly that's rooted in the complexity of individual legal jurisdiction and the way they interpret the laws, custody arrangements, settlement arrangements, etc. So it's possible that there are big markets that will never be able to move to T+1.
Okay, let me go to that end. Jim, is T+1 working, and is 24/7 a good idea?
Yes, T+1 is working for reasons a lot of people don't appreciate. One of the problems with GameStop was that because of our delayed settlement, the collateral required by our settlement institutions skyrocketed. And it was that collateral demand that caused brokers like Robinhood to shut off trading in various meme stocks. By shortening the settlement period, we shortened the collateral needs in our settlement system, and the statistics I've seen show that it's dropped about 30%. So that is working. The number of fails are staying approximately the same. So we haven't seen any real breakdowns. So far, it's working well. Now, I'm a big fan of 24-hour trading, but I don't think every stock will be liquid for 24 hours. Investors like to trade the stocks they know, generally stocks in their own countries. So at 3 o'clock in the morning, very few people want to be trading foreign stocks where they really don't know what's going on. But I think we will see trading activity in various what I call global securities, whether it is ETFs that track an entire market, commodity-based things, crypto things. So I think there's a demand for it, and I think we should provide it.
Catherine, how do you think about these issues?
Yeah, so first, we're already trading, S&P 500 index options and VIX index options on a 24/5 basis. So the experiment is in motion and has been for years, and it really becomes what is the extensibility of what we learned by operating these markets for the past several years in this capacity. I would agree that T+1 has been a huge benefit for the capital markets, as well as things like the uncleared margin rule. So UMR rules have definitely helped OTC volumes come to listed venues, which takes risk out of the system. And back to your auction question, really it is what is the best thing for the retail trader, and do auctions really serve that purpose? In the options market, there are 18 different options exchanges. I think we're on our way to 20 in the not too distant future. And all of these exchanges have some sort of auction mechanisms embedded into their matching engine to try to get that retail client a better execution. And unlike the equities market, where you have the lit and dark trading, about 50-50 hit the lit market and 50% hit the dark market. There's no such thing as the dark market in listed options. Everything comes down to the market and is available to be seen by all participants. So again, a very big difference between the equity and
the
options
lit
market.
versus dark, just for those of you who may not be aware. So the lit refers to the exchanges, of which we have 16 in the equity side, and dark typically refers to the other platforms, the ATSs. Chuck, how do you think about these timing issues, settlement cycle, and whether we go to 24/5 or 24/7?
Yeah, well, I think on settlement, I would just echo what Jim said. I mean, it's been a positive thing for the market. It's reduced capital requirements and so on and so forth, which is always good when you're adding efficiency. It's also, nobody will remember this because nobody's old enough to remember this, but the original T+3 had to do with physically moving certificates on Wall Street. So it was based on a time when there were no computers. So it does, looking at it that way, make a lot of sense to move to something more modern. So I think it's been positive. From my seat, it was a little bit more simplistic to put into place. I think it was a little more complicated for broker-dealers, but I think overall it's been a success, and we had a great template for going from T+3 to T2. So I think it was implemented really smoothly. When it comes to 24/7, I think there are use cases, and probably stocks are probably the last place that will go. And the reason why it's a little different for stocks is they're not commodities. They do have things that occur that are singular, that are not macro, that are singular to those stocks, which can impact the activity in that stock. I mean, there's of course overnight news and stuff like that, but there's also corporate actions and those types of things, which are often complex and challenging for the market to consume and handle. So I think that's probably the sort of operational challenges is probably why, from our seat, we think it'll take a bit longer before it goes into place. If there's demand for it, there's demand for it, and the market will eventually get there. But I think we're probably not quite ready yet.
We want to get to Q&A in just a minute, and I'm going to give Sapna the last word.
Sure. I want to go back to a point Kathy made about auctions in the options markets. The one distinction between the auctions and the options market is there is a backstop. There's a guarantee of execution, which is something that is not in the SEC's proposal for equity. So as much as we hate the regulators taking what works in one asset class and not translating it, maybe this is one area they should have looked at that. And but I felt the need to kind of make that distinction.
But let me just, I'm sorry.
Yeah, go ahead.
quickly ask, just give me your quick gut feeling on this. As we talk about these changes to timing and settlement, I mean, there's always this operational resilience concern that I have, especially having been a regulator. And can our markets, are we pushing things too far? How do you even do an upgrade? Do you worry about those things?
Well, T+1, I think T0 was on the table at one point. So us going to T+1, taking incremental steps, making sure the markets can handle it, a good thing. I think part of and we do trade 24/7 today, right? Okay. Even in the US equities markets, it's available, even if it's not fully from an equities exchange standpoint, it's available to those who want to actually trade. Before we go broader and we mandate everyone connecting to equity exchanges that offer 24/7, I think that's the operational resiliency portion that we need to consider too. What is the benefit to offering it all hours of the day versus keeping the infrastructure up, possibility of outages, having staff that's licensed sitting there and trading? I think those are all considerations before something is mandated.
Okay, I see some head nodding, so I assume all of you are kind of concerned about this as well. But I know we want to get to Q&A from students, or from everybody. But anyone have a question for the panel? It's a little hard to see here. Please raise your hand. We'll get a microphone to you, or I guess we have microphones. Line up at the stairs, please. All right. Have we got one here? Go ahead, please. State your name.
My name is Vic Palaparthi. I'm a sophomore in the School of Foreign Service studying international economics. My question is, I'm curious about your stances on zero-day options and how does that toe the line with gambling? Thank you.
I think, Catherine, that one's for you.
Yeah. I wish this was the first time I had this question, but it's a topic du jour. So zero-day to expiry options, I know they're of a concern to some people, but I'd like to just point out we've had Mondays, Wednesdays, Fridays, expiries for years, and we added Tuesdays, Thursdays, in very liquid only index options and liquid ETF options. And we get to see the data at the exchange level about how our investors and retail traders interacting with these options. The last thing we ever want to do is to invite any sort of black eye in the industry, operational resilience, a problem. Those are not the goal. And so when we look at this data, what we find are that those traders that are engaging in strategy that systematically are using these short-dated options, they're very balanced strategies. Our retail traders today are so much more sophisticated than they were even 5 years ago, and they understand how to put on trades that are capped in terms of risk and really understanding that risk-reward profile. So we see very little, less than 5% of trades that come into these options are what we would deem risky, as in short, naked selling. And so we see spreads and we see very intelligent behavior, but we also monitor what is the net gamma position. So gamma is a way we look at directional risk from the liquidity providers. And so we look at what is our net gamma exposure in these products from our liquidity providers. And what we see is very balanced risk across the entire curve of options, such that it gives us comfort that what we've unleashed in zero DTE options is actually working as intended. Much more precision in hedging, much more precision in speculating, cash settled, so there's none of the complexities that Chuck called out in terms of corporate actions and very bespoke risks to the individual stock. And we've done it very carefully. We had almost 2 years of data in S&P 500 index options before we rolled them out into the Russell 2000 index options. So I would say these have worked as intended and have been a great boon for the industry in terms of risk offset and precision in hedging.
Okay, let's go to another question over here.
Hi. Thank you so much for your panel. My name is Jahal. I am a senior here at Georgetown in the School of Foreign Service. And I'd like to ask you about liquidity and risk management. Liquidity requirements have increased since the financial crisis and continue to face potential increases under the Basel III proposal. But what have your experiences been navigating liquidity requirement regimes, particularly noting the tangible consequences of operating under heightened requirements, as well as the role of other risk management processes that aren't in the spotlight as frequently?
Who would like to take that one? It's kind of more about, well,
It's a little bit more in the banking sector.
yeah, it's more about banking and the people who are doing the trades as opposed to the people running the exchanges.
I mean, I would just
Jim, go
say
ahead, Jeff.
it's important to think about these things and get it right. You want to. Sometimes I think regulators have a challenge where they want to really protect the market, but if they make it so cumbersome for a participant to be in the market, you suddenly can only have the biggest participants in the market. So,
Yeah, Jim.
And let me add an echo of it would be a mistake to take what you do in one area and blindly copy it to another. Brokerage firms and trading firms are very different from banks. They have very different levels of liquidity, very different risk profiles. So to blindly take Basel III, which is designed for commercial banks with very illiquid assets, and apply them to a broker-dealer doesn't necessarily make sense.
with completely
Okay.
different types of risk.
Let's get another question.
Yeah, hi. Thank you so much for being here today. My name is William, and I'm a first year in the McDonough School of Business. And I had a question regarding the role of technology and the cost of trading. So what are some of the most notable technological advancements you're seeing that are making markets increasingly efficient, whether they're AI related or not? And what implications are you seeing these technologies having on the cost, quality, and accessibility of trading globally?
Who would like to?
I would just say, the democratization of technology in general has served the ecosystem well. So if you look a decade ago at what technologies were available to that retail trader, there wasn't much out there. And now they have access to tools that professionals were using years ago. And I'd also say low latency has really driven the market in terms of GPU technology and other things that have really gotten us to a much more low latency environment.
And I'll just add to that, with the amount of market participants that we have in this space, I think we all have the incentive from a competition standpoint to invest in technology and continually invest in technology and update to stay competitive in this space as well.
And resilient.
Jim?
Yeah. And just to add real quickly, it isn't just information technology, computers and AI. We also need to think about financial technology, new products, and regulatory technology, new and better ways of regulating. Information technology has brought tremendous advances. We'll see more financial technology as we invent more products, and there's a big need for regulatory technology to catch up.
Okay.
Thank you so much.
Let's go over here.
Yeah, thank you all for being here. My name is Daniel Ward. I'm Master of Science in Finance in 2023 and an analyst at Arrow Investment Advisors. My question for you all is I'd like to take the panel's temperature on taking markets narrower, say in 2 30-minute sessions to push traders into the better execution that comes in these liquidity pools, rather than going broader and looking at 24-hour trading.
Okay, I'm told our time has actually expired, but so let's do this quickly. Let's get a couple of quick answers to that.
I think if you ask the institutional community, and we make up the bulk of the volume in the marketplace, institutional customers would want to see shorter trading hours, not longer trading hours. I was in Europe a few months ago and talking to European customers. 50% of European volumes executed in the last 2 hours of the trading day after the US opens. And so they're questioning whether they need regular trading hours of the nature that they have. And inevitably, the question that came up in every conversation is, why does the US want to go 24/7? Right.
Actually, on a global level, we're seeing more and more liquidity going into that final auction. So I'm always, in the 24/7 conversation, I'm always fascinated. It comes up every 5 years, and I always wonder if this time it's going to be different. But really, the trend in liquidity is towards concentration rather than expansion.
Yeah, Jim.
And when I lived in California, I hated the fact that the markets closed at 1 o'clock. So the institutions likely, yes, they want to go home and have a life, but for the rest of us, I just don't want somebody telling me I can't trade when I want to trade.
See, when I was in California, it closed at 1 o'clock. I loved it.
Okay, on that note, I think we'll have to end it. Thank you all.
Thank you.
It's been a great discussion.
Happy.